Deutsche Bank once again made a loss in the third quarter of the financial year, with bosses blaming the short news on a failed attempt to restructure the firm, which came about in the summer when it closed branches and slashed jobs. The largest German money house announced recorded losses of 3.15 billion euro in total after tax, with shares plummeting by 3% in pre-market trading. Chief Executive Christian Sewing said, "The transformation is in full swing, with noticeable progress on the cost side and risk reduction. The total income of the bank fell in the summer quarter by 15%, back to 5.3 billion euro. In the last quarter, Deutsche Bank also suffered from declines in fixed income securities trading. One positive is that it gained more in the emissions and advisory business. The bank announced early this year that 18,000 jobs were at risk due to a massive restructuring project that will also see the bank's former flagship branch trimmed down. So far, Deutsche Bank's efforts to offload troubled assets included in its bad bank have been successful. The troubled German lender has already unloaded some assets to rival including Goldman Sachs and BNP Paribas. Now, Goldman's coming back for what Bloomberg described as a $50 billion book of assets, according to BBG. The assets are tied to emerging market debt and were housed in DB's wind down unit. It's difficult to tell whether the sale involved part of the derivatives portfolio, since BBG doesn't include any information about the nature of the assets being sold. But even though DB managed to offload some of its most troubled assets, the unit still managed to book 1 billion euro loss for Q3. The bank can stick to our commitment to manage our transformation without asking our shareholders for more capital, Sewing said in a message to staff accompanying the bank's first investor update in 4 years on Tuesday. Under previous CEOs, the company raised about 30 billion euros in 4 capital increases since the financial crisis. Citigroup Incorporated analysts said last month that they cannot rule out a highly dilutive capital increase until there is more clarity on how European regulators implement new banking standards. Deutsche Bank's Common Equity Tier 1 ratio stood at 13.4% at the end of September. The key driver of Deutsche Bank's lower capital bar is a decline in the ECB's called Pillar 2 requirement and assessment of the risk and individual lender pauses. That component will fall to 2.5% next year from 7.75% in 2019, the highest level among the euro area's 10 biggest banks by assets, while several other lenders had seen their ECB set requirements decline in recent years. Deutsche Bank's 2.75% bar hadn't budged since 2017, companies' fillings show. The bank on Tuesday formally lowered its midterm revenue target to about 24.5 billion euros from 25 billion euros, saying the retail and the corporate clients divisions at the center of Sewing's turnaround will be particularly hard hit by negative rates. Chief Financial Officer James von Moltke previously indicated the target will be below the original goal because the bank's assumptions about rates and the economy had proven too optimistic. To help offset lower than expected income from lending, the bank wants to generate 100 million euros annually from passing on negative interest rates to wealthy and corporate clients, von Moltke said in a presentation. Deutsche Bank also raised the revenue outlook for the investment bank, making its turnaround effectively more dependent on the unit that bore the brunt of cutbacks in recent years. Shares of Deutsche Bank swung between gains and losses, falling 0.6% at 4:53 p.m. in Frankfurt after rising as much as 1.7% earlier in the day. The bank in July had flagged a loss this year and announced restructuring plans worth $7.4 billion, including the elimination of 18,000 jobs. At the end of October, the firm reported a third-quarter loss, which sent shares in freefall. The third-quarter results followed a poor trading update in the second quarter, which puts heavy scrutiny on the bank's operations and management. The quarterly loss follows one of 3.15 billion euros in the second quarter, and in contrast with a 229 million euros net profit a year earlier. Today, the firm pared back its revenue growth target, which sent shares in red. The firm blamed rock-bottom interest rates for bruising business in a modus update to shareholders and investors. The German bank said it expected revenue at its core banking business to grow by just 1% in the run-up to 2022, half of the growth level estimated in July. It put emphasis instead of efforts to cut billions of euros in costs. A statement from Merkel's chancellery was more muted, saying that the talks were ruptured on the basis of a business decision made by individual companies, and the government would make no further comment. Discussions of the risks in Germany's financial industry have intensified since Scholz was appointed last year. The Financial Stability Committee, a group of regulators and finance ministry officials, warned the government in December that the country's banks could face troubles ahead if a deepening economic downturn hits their balance sheets and triggers a capital squeeze, according to people familiar with the discussions. Deutsche Bank is a particular concern in political circles, said the people, asking not to be identified, discussing internal deliberations. The country's largest lender is considered systematically relevant by regulators and has continued to struggle after a series of missteps during the financial crisis a decade ago. Professor Richard Wolff, one of America's most prominent economists, claimed that if Deutsche was in trouble, it was likely far from alone. He explained to RT America that the extent of the crisis would not be known until something blows and the whole game is up. The Manhattan-based professor told RT host Rich Sanchez it will be easy to find statements by experts, by banks of CEOs, by Wall Street commentators telling us not to worry. It's a detail, it only affects one bank. None of that is normally true. Deutsche Bank is the biggest bank in Germany. It is one of the biggest banks in Europe and the world. If it has serious troubles, those troubles are also affecting other banks, and they are affecting the interactions between a monster bank like Deutsche and all other banks, since these banks do an enormous amount of business with one another. Deutsche Bank's announcement has left some shareholders deeming the German financial giant uninvestable, with strategist Mark Joly also claiming more trouble could be ahead. The Frankfurt headquartered bank, Deutsche Bank, said their 91,500 employees are set to be cut by just over 20% to 74,000 in an unprecedented round of departures. Strategist of CCB International Securities, Mark Joly, warned that European banks may not yet be out of the woods. He also agreed that this latest decision by Deutsche Bank could make them uninvestable for the majority of fund managers, as this restructuring process is not a quick fix. The German economy is slowing down at just the wrong time for Deutsche Bank. Deutsche Bank's restructuring plans has been ambitious from the start, and Germany's economic slowdown will make it that much harder to achieve. The banks who are forced to buy bonds at these high prices will eventually go under when the bond market bubble pops. A demand or attempt at a government bailout will bring in hyperinflation. The dollar funding crisis is real and expediting, as is the collapse of the German economy. What everyone needs to be concerned about now is the turnaround against the gigantic move into European sovereign debt. These bond yields have resisted gravity all year and cannot be persistent against a declining euro. Germany is in big trouble, and with it, the whole European project heading into an economic collapse. The massive debt levels brought on by using a debt-based currency are killing the EU. The United States and its vassals are all crashing at the same time. Pretending to own gold is not the same as owning gold to pull you out of trouble. A major stock market crash is coming fast, and most of the Western world still thinks that printing money will save them. Big economic collapse is coming. The collapse will happen despite the central banks because it is due. Poor old Germany will struggle more because they are used to being wealthier. Most of the idea, comment, information and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is advised to consult an expert before making this decision.